Second, what determines bond yields? So you'll see a bond yield chart in the form of a term structure of interest rates appear in the Wall Street Journal every day, usually in the back of the hard copy newspaper. If you look in the old-fashioned paper, it's usually in the back, in a very small window. It's a relationship between nominal interest rates on default-free pure discount securities and time to maturity, the pure time value of money. Term structure is most times upward sloping, so that short-term rates are lower than long-term rates. So if I buy a 1-year T-bill, it's usually paying a lower interest rate than a 30-year government bond. Typically, this is what happens. Occasionally, it will be downward sloping, where long-term rates are lower. This is very rare, but it does happen occasionally, where short-term rates pay lower than long-term rates, or short-term rates pay higher, than long-term rates. This is composed of the components of the Fisher effect. So the term structure is composed of the real rate of interest. You want some compensation for foregoing the use of their money. And you also have inflation. You want some inflation protection or inflation premium. And also RH, you want some protection from interest rate risk, because we know as interest rates go up, your bond values go down. The longer the time to maturity, TTM, the greater the risk. So you want a greater interest rate risk component for longer term bonds. Here's the term structure that appears in the Wall Street Journal, and this is the Treasury yield curve. Plot of yields on Treasury notes and bonds relative to time to maturity. Again, typically upward sloping. Short-term bonds are paying less than long-term bonds. And again, appears daily. You can see this in the Wall Street Journal. When you're looking at Treasury notes and corporate bonds, you have to look at default risk. Are you getting a default risk premium for taking on that corporate bond, which may default? Are you also getting a taxability premium, because these corporate bonds are taxable? So you're going to reduce your return by the amount of tax you have to pay. And also liquidity. They're not always liquid. So you should get a little piece of liquidity premium when you buy these corporate bonds. This is compensation for lack of liquidity. That concludes our session on bond valuation and interest rates.